Hello bro, good morning and welcome back to the new stock evaluation video. So today we are going to analyze this company called EPR Properties with the stock ticker EPR. And there is actually one reason why we are going to analyze it. They are paying monthly dividends, so if you are a dividend investor just like I am, this stock might interest you, so we are going to take a look together. We are going to analyze it together and then decide whether we should also add it to our own portfolios, okay? Now, as always, we are going to analyze EPR using this little Canva presentation that I prepared right now here. So let's begin. First of all, why should you even listen to me? Because I seem like some random guy from the internet, right? Now, my name is Yasha and I help young men from middle class invest in the stock market and actually make some money. So if you are interested in that, when you have more trust for me, click the first link in the description and I will teach you everything about that. Now let's begin with the actual analysis. So this is going to be very beginner friendly, straightforward, simple. I don't want to waste any of your time. I don't want to overcomplicate things. So just grab a pen, follow, maybe learn something new, and that's it, okay? Now, as a complete beginner, you should generally care about the following 6 things when you analyze the company, okay? You should care about chart, profit, debt, money on the bank account, value, and the price. Now, first of all, EPR Properties, it's some real estate investment trust. This REIT, that means actually that. So it was founded in 1997, and basically what they do is they buy properties and then they rent them out. It's that simple, okay? They are investing in real estate. Now let's begin with the actual analysis. So first of all, we are going to start with the chart, okay? And for chart, we have a little instruction that tells us chart has to grow for all 10 years. Now, what exactly does that mean? That means that I will draw a little exponential growth line, kinda like this, as you can see right now on the screen. And then we are going to compare the stock price, which is the orange line, with that exponentially growth line, okay? And preferably they should follow each other because that means that the company is growing, okay? Which is what we want to see. Now, what do we have here? Here we have actually exactly the opposite, okay? First of all, the company is growing until 2020, and then the COVID happened and the stock completely plummeted. You know, it went down significantly, and right now it stayed around there. It's slowly growing, as you can see, but it definitely doesn't follow that exponential growth line, bro. That means company is not growing exponentially, which is what we don't want to see at all, okay? So chart is not good to go. Now we come to the profit. And for profit, we also have a little instruction. Profit has to be in plus and it has to grow through the years, okay? Now here, what do you see? You immediately see that in 2020, they had loss. So this is immediately a no-go. I cannot stress that enough. If you want to buy companies, they have to have profit for the last 10 years and that profit has to grow, okay? Now here, obviously, due to COVID, they probably lost a ton of money. That's why they are in minus, which is what we don't want to see, okay? Really, I cannot stress that enough, bro. Don't invest in companies that are making minus. You have to be harsh, and here we have to be harsh as well. They have minus, so no go. Chart is no, profit is no go, bro. We don't want that, okay? Now we come to the debt, and for debt, we have also an instruction that tells us debt has to be low, and preferably it should decrease through the years. Now, what do we have here? Here we actually have to think about the following. Now, this is a real estate company, which means they are buying real estate with debt. So the more debt they have, the more real estate they can buy, and the more real estate they have, the more they can rent it out and have that monthly payments, those monthly payments, you know, from that real estate. So actually, the more that they grow, the more debt they will have because obviously they buy real estate with a debt, okay? Now here we can make an exception. Whenever you have a real estate company, the debt should be growing, okay? Obviously, if you have Apple or Microsoft or some other bank, debt should be lower, you know, but here in this case, with real estate companies, it should grow. So it kind of grows, which is what we want to see. So debt is actually good to go. And now we come to the money. And for the money, I literally mean how much money do they have on their bank account, you know. That money that we are going to analyze is literally the money that they can withdraw at any given point. They can go to their local bank, I don't know, Wells Fargo, UBS, Bank of America. If you are from, I don't know, if you are from UK, maybe they can go to Lloyd's or however that bank is called, you know, and then withdraw that money. It's that simple, okay? Now, preferably they should have more money than costs on their bank account, because, you know, life is kind of unexpected. If you have more money on the bank account, if you have bank account balance in plus, that means that you can maybe pay some unexpected costs. Something unexpected happened, you know, you can cover that without any worries. This is what I mean here. You know, we want to have that security. We want to have positive bank account balance so that we can cover potential surprises, okay? Now, what do we have here? Here we have plus $260 million around, you know, on the bank account. So they have more money than the costs. Obviously, bro, use your brain. They have plus 250 or $60 million, which is what we want to see. They have enough money to cover something unexpected. So we are good to go. Nah, a bit of a joking, bro, but let's continue, okay? Now, here we come to the value, okay? And obviously, when we invest in stocks, we want to invest in undervalued stocks, because if we invest in undervalued stocks, then we have higher chances that they will grow in the future. Now, how do we measure valuation? We measure value by two simple concepts, okay? First concept is so-called P/E ratio, and the second one is called intrinsic value. Now, as a complete beginner, this might sound a bit complicated. There are some concepts or whatever, but as a rule of thumb, you should consider the following. P/E ratio should be lower than 15, and intrinsic value should be higher than the current price. Now, let's discuss that a bit more. So, P/E ratio of EPR is currently 20, which is a bit higher than 15. So, P/E ratio is actually a bit overvalued in terms of that, okay? Now let's come to the intrinsic value, and I want to have your full attention when I explain this concept, because this is extremely important. Now, intrinsic value tells you what should be the price of this company at this exact moment, based on calculations from their financials, okay? What do I mean by that? Now, this sounds way too complicated. Basically, bro, intrinsic value is the price that they should have right now, but the current price is the actual price that they have right now. You know what I mean? So let's break that down here in example. So intrinsic value of EPR is $55, but the current price is $41. That means that the current price is actually for around $15 lower than it should have been. You know what I mean? This is intrinsic value. Intrinsic value is the price that the company should have right now. I know that I'm repeating myself way too much, but I really want you to understand this concept, okay? So in terms of the intrinsic value, the stock is undervalued because intrinsic value is higher than the current price. Now, you can find both P/E ratio and intrinsic value on the internet. Just turn on Google and write EPR Properties P/E ratio or EPR Properties intrinsic value, and you find the information. Let me quickly also explain what P/E ratio means. P/E ratio measures how undervalued is the stock against the competitors, okay? So obviously the lower the P/E ratio is, the better it is, okay? My own preference is that P/E ratio is lower than 15, because that means that the company is undervalued, okay? It's that simple. And now we come to the current price. And for the price, we have here an instruction that tells us price has to be lower than 150 euros or dollars or British pounds, you know. Now the current price is around $41, 41 and a half. So it is significantly lower than 150. So we are good to go. Now 150 is kind of the price that I decided for myself, where I decided, okay, above that, the stock is overpriced and I don't want to invest in overpriced stocks. I want to have like humble, small, basic beginner stocks, you know, that might grow in the future. So that's why I decided that 150 is kind of the best border between overpriced and underpriced stock, okay? Now we come to the final evaluation, where we are going to just summarize and break down in more detail what we found out so far about this company. So let's begin. First of all, bro, does the chart grow? No, it doesn't. It doesn't even grow exponentially, so that's not good to go. If you don't believe me, go a few minutes back and watch the whole video again. Now, does the profit grow as well? Technically, it grows. But bro, we must not forget that they have minus in 2020, which is what we don't want to see at all. Immediately when you see minus on the profit chart, that means that the company is a no-go for sure. We don't want to lose money. We don't want that the company loses money. It's that simple, bro. That's the harsh reality, and we have to deal with that. Now, do they have a growing debt? In this case, they do have. In this case, that's an amazing thing, because they are investing in real estate. So when you invest in real estate, you have to have more debt because you buy real estate with the debt, you know. I know this might sound a bit complicated. Drop down in the comment if you want to know more about real estate, bro. I can teach you some basics, so let me know, bro. Now, do they have money in the bank account? Yes, they do. I think they have like $250 million, so that's good to go. In terms of the valuation, are they undervalued? No, they are not. With P/E ratio, they are not, but with intrinsic value, they are. But we want to be as harsh as possible, so obviously we will say no, just to be sure. Now, is the price below 150 euros? Yes, it is. It's around 41, 42, somewhere in the middle, 41 and a half. So yeah, it is. Now, should you buy or sell EPR Properties? In my opinion, bro, you should sell it. Now, why should you sell it? Because of the simple reason that they have loss in 2020. Profit was in minus, which is what we don't want to see at all, okay? Chart is also bad. It kind of was growing through the first years, you know, and now it's kind of dropped down completely. It fell massively, so we don't want to see that, okay? Additionally, they are paying way too much dividends, because when I did my in-depth research, they are paying actually much more dividends than they are receiving the cash into the company, which is completely unsustainable. So in my opinion, they are spending way too much money on the dividends, they are spending way too much money on the properties, and they don't get that monthly income back, you know. So in my opinion, I would not buy this company because of those reasons, okay? They have loss, the graph is not good, they are paying way too much money in terms of the dividends, they are not reinvesting the money, and that's basically it, okay? Now, if you want to know more about stock market analysis, stock market investing, click the first link in the description. If you want to know more about those videos, bro, more about analysis, click subscribe, join me on this amazing journey, do the hard work, and see you on top of the world.